want to thank you all for coming here this evening. Thank you very much for coming out in the weather. It's good to see everybody here. I'm Michael Rains. I'm Director of Quantitative Data Solutions at Wall Street Horizon. I want to thank the Lucena research team that is with us today for hosting this event, Erez here at the table. And I'm also get the opportunity to introduce you to the moderator to this evening. Rich Carbone is a vice president and a member of the data strategy team within Jefferies LLC. Rich has advised over 100 investment managers' data science teams on their build-out efforts and evaluated over 300 data vendors. Rich recently co-authored 3 pieces of data-centric content, including 2 white papers on data science and the buy side, and another proprietary data survey. He is also the author of Jefferies' data-focused weekly newsletter, The Friday Five. Rich began his career at Bloomberg, focusing on fixed income analytics for the Bloomberg Terminal. Ladies and gentlemen, Rich Carbone.
Thank you to Lucena and Wall Street Horizon for having us and me. Very much appreciate it. So over the course of the next few minutes, we're going to have a pretty informal conversation about things we're all seeing in the alternative data space within investment. We come from different backgrounds, buy side, sell side, vendor, and we think we all kind of bring a different spin to what we're seeing lately in the industry. So I'm going to introduce the panelists one by one with Olga Kokareva from Quantstellation, Erez Katz from Lucena, Barry Starr from Wall Street Horizon, and Jeff Ferro, who's a longtime investor and a user of both of these products on stage. So Olga is the head of data sourcing and strategy at Quantstellation. She sources data for them. It's a multi-strategy, multi-horizon quantitative investor. She spent a number of years doing sourcing for different quantitative funds. She was at ITI Group, she was the head of the multi-manager hedge fund platform, which focused on quant as well. She was also at Da Vinci Capital and started her career at Renaissance. Erez is the CEO of Lucena. He's a serial tech entrepreneur, and he was at Objectware, which was sold to Bridgeline, which then IPO'd on NASDAQ, and he assumed the COO position. Barry founded Wall Street Horizon in 2003. He has brought the company through monumental growth since that time. Before that, Barry was an executive at Fidelity, where he developed multiple platforms, including their investments advisor group, Fidelity's Online Express, and I couldn't leave this out, but he was fortunate to be a witness of the birth of the personal computer, working with Steve Jobs at Apple his first time around. And then Jeff Ferro is a longtime portfolio manager and investor. We actually had the opportunity to work somewhat together most recently when Jeff was working on Battlefin's alternative data investment platform. But he spent time at fundamental long-only equity shops, to an equity plot at Lehman back in the day. And Jeff has industry expertise using products on stage, using a lot of alternative investment products. So we thought it'd be helpful to have that unbiased view. So going through what the panel will look like, we hope by the time you leave today, we're going to address a few things, just the state of alternative data overall and the categorization within all data, some of the pitfalls to integration to this point, modeling alternative data into fundamental and quantitative processes, since we have both expertises up here, the building of strategies and the crowding of strategies, creating tradable signals and maintaining them, and then recruiting and talent, because that tends to get overlooked as a need and something that is not easy to come by when you're competing with some of the giants in the city, in the country, and the world overall. So we're going to start broad and then go in. I think what we wanted to start on was really what you categorize data as alternative. Erez, maybe you can get started there. I think you have a platform that's doing all these things. What categorizes data alternative, and maybe what are the categories within that?
So we see big data in general as a broad category that can be broken down to 4 distinct subcategories. So most of you are familiar with the fundamental, technical, and macroecon factors that have been around for a long time, all the charting and all the data analysis that's done on price volume or on the physical performance of a company. In that category, of course, the macroecon as well, PPI, CPI, GDP, and the likes. Now, below that is in the rank, there is what we would call equity-specific alternative data. These are things that have not been looked in the past upon, such as insider buying and selling. We have actually somebody from that category right there in the back, or other types of equity-specific information that could be a telltale sign about a firm. And Wall Street Horizon is actually one of those categories because they capture data at the event data at the company level. Now, right below that, there is what we call, that's the biggest growing group of alternative data. These are companies that are operating not in the data space, but they collect data as part of the business. Think about UPS, shipping data, NCR, point of sales data, credit card transactions data, and the likes. These are companies that have never planned on ever selling their data, but there's obviously huge opportunities to expand their channels of distribution and revenue stream by mobilizing and selling the data. And the last category is basically unstructured data. These are data sets that have never been used in the context of investment professionals, such as social media sentiment, transcripts of earnings calls, such as what Prattle provides, and many other companies that, again, are trying to digitize unstructured data through natural language processing and create some sort of a predictive signal.
Olga, you've mentioned that you really do break out alternative within the data sphere. How do you categorize alternative data versus other data that you're using?
When people in the industry are asked what alternative data is, most of them answer it is anything which is not traditional data, and for some reason, 99% of the time, they bring up satellite images. My definition would be a little bit different. I think to define alternative data, I would need to take a step back and talk about what the concept of hedge fund is all about. It's about having an edge to generate alpha. And there are only three ways to have an edge. Either have data that nobody else has, or have the same data everyone else has but get it before them, or have the same data and use it in a different way. There's only three ways. So I think that there are three categories of alternative data. First is data that hasn't been available only a few years ago, like email receipts, like web scrape data, like things that didn't really exist before. Second one is something that existed before and we've been using as hedge fund managers forever, like foot traffic. I mean, like hedge funds used to send their interns to literally count people walking in the store. Now we use big data to collect it. So we just use alternative way to collect this data. And finally, the numerical structured data, that's looks like traditional, but it's all about the way you use it. So for example, when people use order book data to actually generate alpha rather than just calculate cost analysis, to me, it's also alternative data. And if you think about alternative data this way, you start understanding why it's so important. And it's not just as a ethereal thing that's only relevant for a handful of quants. It's actually super important for investment industry as a whole.
Great. And Barry, do you have a thought on that? I mean, I would designate your data set as something that's alternative, but as Olga said, something that's been important for years and years.
Well, I agree with 99% of what Olga said. I think another term for alternative data, and we use the term alternative data, but another term for alternative data is specialized research. I mean, people have been doing this research. It's just a different way of doing it. Satellite data, counting cars in parking lots. Well, guess what? 40 years ago, there were physical people going around counting cars in parking lots. It's just a different way to do it. Credit card receipts, there were people in stores, with clickers, counting, looking at people when they're going through checkout lines. So it's just a different way of doing what's always been done. So I would call alternative data just new creative ways of getting it research.
And Jeff, rather than going through the categories, what do you think are some of the issues so far about getting into the alternative data space? I think there's been some pitfalls to adoption. I think the spend numbers have actually been lower than I would have thought at this point, maybe looking back 3 years. You've been through it a few times, and I'd love to see that.
There's a couple parts to that. I think the first part is being able to define this source of the information. We find it that when the data comes in, you really need to understand the intuitive value in it, and then structure your investment and your research process around a thesis and what's the information that you're trying to get, and focus on that. And I think that people don't trust the machine learning process behind it and why it's going to help them. And we find that we've had to run portfolios for outside managers side by side for years at a time, just to prove to them that the information that's coming in is of value. And I think understanding, having the data delivery side, being able to define where the alpha is coming from is basically what needs to be enhanced for the buy side to really adopt it and wholeheartedly.
And Olga, is it too late for investors to start implementing strategies and or start bringing in alternative data if they haven't yet? You've started to, you've done this at scale for a while, and you've had a head start, but if someone's looking to get in, what are they looking at, and how could they do that?
I don't think it's too late. I think it's probably going to be too late in the nearest future, but not for the reason people think. People think it's too late because the space is overcrowded and alternative data doesn't work because everybody is using it. But I think it's going to be too late because if you don't use it and you're trying to raise capital or to make money as a portfolio manager, you just won't be able to compete because everyone else is using it. And as for overcrowding, and we can talk about it a little bit in more details going forward, but I don't think that this is an issue that can be resolved now.
Jeff, do you have a thought on the fundamental side? Just how, if it's too late and how you can integrate things if you haven't yet?
I think it's the first inning. I mean, it's just getting started. There's so much information out there, and even if it's data that's been around for a long time, it's your ability to put a creative spin on it, and it's the basically the new features that you can create off the data become the data in itself, and then once you get to the point where you can start combining features to then have a new insight, there's data that could have been around for 10 years. You have the new features of 3 different pieces of data set, and it's something new and very interesting. You start combining these with even traditional data, and you get new insights. On the fundamental side, even if you haven't started yet, start with one piece. Look at your normal process and and think, what's one piece of information if I could do that just a little bit better, and start there and seek out data that can make that just incrementally a little bit more efficient, more precise, and then work on to the next part of your model. Even if the buy side thinks what they're doing is correct and working well, if the information's there, you can always do better. And the part that I think is really interesting about alternative data is it's not, a lot of guys from the fundamental side that I talk to that haven't got into it yet just think you throw it into a computer, it's done, and that's what it is. And there's a real creative and thought process that can be very informative.
And so moving over to what the data providers are providing, Barry, what have you seen from large financial firms with in-house quant offerings or quant firms overall? What are they asking of you? What are you delivering that's above and beyond what a sell-side firm like we would be delivering on the opinion side?
So, actually, great question. It's probably a good opportunity because I've heard the terms kind of bounce around a little bit. So if you don't mind, I would like to digress for just a second, okay? There's a big difference, in my opinion, there's a big difference between data and information and knowledge, okay? Data is data, and we talk about alt data. Data is raw data. Wall Street Horizon, we spend a lot of time turning data by manipulating it into clean data. Then you take data and you manipulate it, you transform it, you do things to it, and you turn it into information. Information is much more valuable than data. In our case, in our world, we talk about revisions to earnings calendars. Calendars are just, in our world, calendars are data. Changes to the calendar is information. You take information and you manipulate it and you add value to it, and that becomes knowledge. All right? In the case with these Lucena guys have done to our data, which is kind of how we got to be here, is that they've created some signals off of the data, and that's knowledge level. And then you take that knowledge level and ultimately you turn it into alpha by incorporating it into all your strategies and things like that. Okay? So the answer to your question is what people are looking for. Well, we find, and there are a number of our clients here in the audience today. I can't point them out because they won't agree to being notified. But we have got clients that like just the data and they do all the work themselves. We have clients that are interested in the changes because they're interested in the information layer, and then they have different groups of people inside their companies using that. And then we have folks who are interested in really just the signals. And that's what Lucena folks do. And so, what are people looking for? I think people are looking for a spectrum up and down that range, depending on their bench, their customization, the types of things that they're looking for. And so it's all over the map.
Erez, what do clients expect of you when you're taking data and making it information? Yeah.
Sure. So let me kind of answer the question in a little bit of a roundabout way, if I may. So if you think about the consumers of data, okay, you have the spectrum of short-term investment, time horizon, and all the way to really, really long. The Warren Buffetts on one end of the spectrum and the high-frequency traders on the other side. Now, if you think about the type of skill that you need to have from data and automation perspective, as you get closer to the high-frequency side, you need to be faster, not necessarily smarter, but you have to be very, very fast to make quick decisions. At the same time, if you go with a longer time horizon, the Warren Buffetts, you have to be really, really smart and have the foresight and the personal, capabilities, the talent to be able to kind of identify long-term vision that others may have not able to. In the context of data, the ability to use data effectively, it basically permeates across all spectrum of time horizon. But the type of data you need for short-term investment is much different than the one for longer-term investment. The ability to identify signals, so if you're fully automated and you have a simple model, simple data that's basically available to the public, this is not going to work for you. It's already been exploited. You have people with cell phones now everywhere in the world with one push of a button looking at a chart and can buy, on the 200-day moving average crossing the 100-day moving average, which you hear about, in the news all the time, but it's really not an exploitable signal. The idea is to find data in the context of the hard-to-find combination of multiple factors from multiple data sets that can provide information that's not available to the naked eye. And this is kind of what we see the needs are from the community of data consumers on the buy side.
Thank you. So, Olga, let's move it to a little bit of actually creating strategies around data. So what are some of the steps initially taking alternative data and actually deploying a strategy?
I am a bit of a skeptic when it comes to using ready-to-use signals. Maybe that's because I belong to a quant firm. I think one of the problems now that we see is that vendors tend to run into one of the two extremes. So one vendors go like this. So here's a data dump, no mapping, no cleaning, no nothing. It's $1 million because we heard that quant funds buy data for $1 million. That's what they heard. Now, but another extreme is they're trying to create a signal. It's almost like buy or sell, which is offensive because we are like portfolio managers here. We're supposed to do this. But the problem with that is what happens, they take a data set, they extract a feature, they look at it, They build quantiles, they build portfolios, start measuring it, back testing, and they come up with a performance of, let's say, 5% with 20% volatility. Okay, it looks good. They extract the next feature and do the same thing, and it doesn't really perform well. They throw it away, and they go, okay, we've done everything that we could. They take it and start marketing it, and their portfolio managers look at it and go like, 5% with 20% volatility, that's all you can do. Alternative data doesn't work. Besides, it gets overcrowded. It just doesn't work. That's a hype. And a lot of times when I meet with those with those vendors, I ask them, if your signals are so good, why don't you trade on them? And that's, I think you mentioned it on a blog post recently. That's a legit question. And the right answer that I want to hear is that I'm a data vendor. I know data. I'm not telling you what to trade. Here are a number of features that covered by this data set, and it's up to you how to use it, how to build, how to put it in the context, be it fundamental discretionary hedge fund that knows the companies they cover so well that they can put it in the context, or maybe quantitative fund. We overlay a lot of different data sources, a lot of different data features, and can build, use machine learning and build strategies based on that. So I think this is a big mistake that I see vendors do, and that'd be great if they try not to do other people's job.
Erez, what do you think?
Yeah, I'd like to add. yeah, this is definitely up exactly 100%. I agree with Olga. So here's the thing. It depends on how much automation you are applying to the final decision of the trade, right? If you are a discretionary portfolio manager, there's some level of intellect that you have to basically override what the machine recommends, or even enhance your decision making with a machine. But it's really not to replace you, really. It's really more to augment, extend, verify, validate. But at the end of the day, that's really how data can be used effectively by different managers in different ways, right? That's the idea. If you get to the high frequency world, which is not something that we do, then there's no human discretion. It's completely algorithmic, and that's a different story altogether. But again, then the use of data at that point is very limited, because you have to be very fast. You cannot conduct, computationally intensive, cycles to come up with a decision. But in a multi-day, short-term, long-term strategies, we definitely see data behaves very well with a discretionary manager. That basically, you are correct. It is up to them to decide how to deploy the data. We're not in the business of telling them how to trade. We are telling them that data is predictive. It provides signals. We provide empirical evidence by traveling back in time and showing them historically how the data translated to potential alpha. But again, it is not how to trade, because there's so many other obstacles that they have to think about when you actually conduct live trading of a large portfolio. It's starting with transaction cost analysis, dark pools, and routing of orders, and all the good stuff that prime brokerage services are doing that we're not even touching. We're just talking about a signal that has an empirical evidence that it's got value, and beyond that, it's up to the manager to decide how to deploy.
So on that, Jeff, how did you start to look into creating strategies, and what were one or two things that allowed you to say, okay, this is ready to go live?
One of the parts that using Quantess and Lucena is, after our data team would come up with our own standardized feature and data delivery, I was able to upload it into Lucena. And because our team could come up with, hey, this strategy works great, and here's the return, and they'd be astronomical. And back to being able to define why this is going to be astronomical, team would just say, I don't know, the machine says that, and this is what it's going to be, and I can never get the definitive answers out of them. So I can take a data set that we would standardize, load it into Lucena, and have that machine then search for individual features. You can ever build off of one or even find 5. Then it tells you, here's the returns if you add these 5 features to it, or over this type of a strategy. And then I could actually look at those and say, there's no reason why that should add any value. That's just a random fix in here. But this one's very interesting. This one matches, or it makes it understand why these two may work together. get rid of the other two, now run it with these two together, and then start building from there and finding new features that make sense. And I consider that more the assisted learning versus the unassisted learning that some of the machine models were run in the background. And it really made me understand why the alpha was there in the strategy we had, and then at that point you can then start adjusting trading frequency, durations, holding periods that would make sense. And then once you understand why this longs are working, use that to then reverse engineer shorts or hedge off of it. So it really helps us define the process and understand why the alpha is there, and then at that point segregate it and really hedge out.
Olga, what are some of the things that you said, okay, this is ready to go live, and something that you believe a strategy was ready to start trading on?
Well, for us, because we are purely automated quant shop, we do back testing, we do auto-sample testing, and then this is an ongoing process. It's not like we evaluated data set, we started running it live and just forgot about it. It's just not the way it works. We keep monitoring it because although it's a separate conversation about overcrowding and in the alternative data space, but alpha decay is a real thing. I mean, it happens. So we have to monitor it all the time because sometimes it happens that the quality of the data set changes only because a data vendor makes some changes in methodology or delivery frequency, delivery schedule. And other times it's just alpha decay. We have to just reconsider how we use this data set, maybe combine it with something else. So the answer to your question is just an ongoing process.
Barry, so Wall Street Horizon's been around since 2003.
Yep, 16 years.
So some may say that either the data or some of the signals you've created could be overcrowded. Why are they wrong?
You look at the facts. The facts show that the signals still exist.
So I guess moving into an overcrowding discussion.
I was just going to add to that, just for the fun of it. They gave me Wall Street Horizon data to play with on Quantest. I got to play with it for a couple hours and ended up coming up with a long strategy that beat the S&P by 20% over the course of 3 years. Once again, it's a shorter term, needs a lot more work, but just using the featured data through the system helps you understand it, and then you can further define it and build off of it.
See, it works.
Please, that'd be great.
Data signal can be overcrowded, no question about it. And like anything else in this industry, after a while, it becomes common knowledge, and it gets to be so common into obsolescence in general. The way to prolong the life of the data or strategy is to have a complex and non-trivial way of using the data. I'll give you 2 examples of how we do it, how we help some of our customers do it. One of the ways to do it is to create what we call a multi-expert ensemble fund. Essentially, the idea is to create a lot of what we call weak models that have a very slight advantage over the random walk, right? So let's say 53% is the threshold to overcome transaction costs and slippage. So if you get kind of anything that has a little bit above that, but you have lots and lots of models that are uncorrelated with each other, in harmony, they can create a voting ensemble that can actually vote together on the same asset universe and create some sort of a bias towards one constituent or another. Now, the way these multi-expert models work, it's actually more complicated because you have to realize how to create those uncorrelated, multi-factor models that are not voting for the same exact reason that the other one. So you have to find ways that you have jury of peers that are voting for a guilty verdict or innocent verdict, a buy or sell verdict for different reasons. And you can do that by segregating the data that you use for these multi-factor models, or creating from the same factors different configurations that would basically be uncorrelated to the other models. It's not an easy thing to do. But once you have that, you can start assessing how well these experts had voted in the past. And the one that had voted well in the past, that was successful in how they rank constituents for buy-sell, let's say, signals, you can give them more weight versus others that have not done well. So what eventually happens, you have these really dynamic multi-factor models that can kind of move around and adjust to the market dynamically. So these are the things that can prolong the value of the data in the context of an algorithmic trading. And these are things that many quant shops are trying to do internally. Again, we help facilitate those structure as well. Now, one other thing that's happening is that data can be effective in one market regime, and the same data can be effective differently in other market regimes. So the notion of retraining the models, right? The whole idea of when do you need to retrain the model so you don't suffer this alpha decay. You're going to have alpha decay on every model you have. There's no model that I know of that exists forever and ever, no matter how novel it is. Eventually it gets exploited. I remember there was a story about co-integration, pairs trading strategy. So you can find basically two stocks that can move very similarly over time. Now what happens, sometimes they diverge for one reason or another. And the notion is that eventually they always converge back again. So the whole notion of strat arb, you can long the first one or short the other one, because eventually you're going to make money by them converging back to be the same, no matter how the market is moving. So that notion was actually very popular in the 80s until one day Knights Capital put a white paper, and you can see in 2012, that strategy, we actually tested it out. The strategy was actually back testing really well through 2012, and then it just got flat all of a sudden because somebody published a white paper and then everybody was doing the same thing. And nowadays it's not as simple as just doing a co-integration. So technology evolves. It's a really leapfrog game. You have to be ahead of the game and you have to reinvent yourself. There's nothing that you can sit down on your laurels and say, okay, I figured it out. Everything's going to go really well for a while, because you have to be with your fingers on the pulse at any given time to repurpose the data and effectively prolong its life cycle.
So we actually have a good use case here, and recently you evaluated or you looked into Wall Street Horizon's data, decided to partner. Why did you look at them, and then what led you guys to believe that you had a good alpha generative signal from their data?
So we actually publishing, it's not secret that we've identified how corporate event data can be used effectively in the context of Wall Street Horizon's data. So number one, the data has to be accurate and has to be professionally provided. So you don't have any nans, any slippages, any stoppage in the middle or breakout of signals. And they've been really the best that I've seen from corporate event data, even compared to some of the traditional sources such as, and I'm not going to mention names here, that you would consume data from. So from that perspective, they have an amazing quality data. And that's the first thing we check when we actually go into a research like that. But we found, for example, through feature engineering, so you take the raw data and you basically derive features that are more machine learning friendly than the raw data itself. So if you have, for example, corporate event, earnings date of a company, that's by itself may be informative, but if somebody changes the earnings date or pushes it back or makes it earlier than the previously published date, that's an interesting information that we can actually exploit to identify if there's something going on that causes them to delay the earnings announcement or make it earlier. Now, that by itself is not necessarily informative, but when we combine, for example, our short signal that we identified very effective. Actually, it's been live since February, and it's doing phenomenally well. We have 3 positions that are doing great. It could be luck, could be a result of the signals, but the fact is that we then identified that the companies that actually move their earnings date forward within a certain number of days before the earnings date, right? And the analyst recommendation consensus is below normal, and the free cash flow is below normal. These 3-factor combination is very informative that they are going to underperform for the next quarter. And we've tested it, and this is not something I concocted from my mind, and I said, you know what, let's just try it out. The machine goes through a classification process by which it identifies all these combinations and identifies what is the proper combination of factors, or what values, what thresholds together are going to be more informative for a high probability move. And that's what we do through machine learning. And again, it's a pretty involved process, consuming the data, deriving features from the data itself, and then feeding these features to a classifier that goes through a very, I would say, exhaustive process of checking the combinations. And again, it's very important not to overfit, which is one of the biggest challenges of doing this process. And we actually break the time frame to training and validation, and there's no overlap in the time frame to ensure that what you are identifying or fell on maybe by chance is really sustainable for multiple unseen data all the way to perpetually forward simulation. And that's how we validate the signals and provide the best that we can as far as the quality of the signal moving forward.
Barry, how about on your side? You obviously entered into this partnership from the other side, and at some of the Olga's risks that she mentioned before, you had a strong data product and moving it into an information product. What incentivized you to join with Lucena, and what have you found since the partnership has been most helpful?
Well, it's still early and we're still growing into it, but kind of
dating.
But as I said before, for 15 years we've been selling data, and we've had a variety of folks come to us, market participants have come to us over the years who've said, love the data, just don't have the bench, just we're interested in the signal. We're interested in a set of signals. Can you do that? And for 14 and a half years, we just didn't do that. But we finally we actually started a relationship with Lucena a couple years ago, and we kind of went through a couple different things, and we kind of finally hit upon this, and this has been really good. And again, it's different firms act in different ways and have different data needs at different times. But if you have a data need, if you have an information need, you have a knowledge need, depending on where you are. For 15 years, we only were dealing at the bottom level of the stack, and what this thing does with Lucena, this relationship with Lucena allows us to do is to create an offering for someone who's interested in really just the, I get it, I get the math, I get the black box, I understand the machine learning, I understand how all things was together. Really all I'm interested in is give me the signal. Here's the needle, stick in my vein, here's the needle, that's how we go. So that's how we got there.
Great. I think before we go to audience Q&A, I'm going to ask some of my own cues. More broadly, is there any piece of research or alpha generative signal that you can mention that you've read or seen over the past few weeks, few months that you'd like to share with the audience that maybe they haven't seen before?
So I want to start by telling you that getting feedback from the market in a non, intrusive way is really, really powerful. So I'll give you an example. I was sitting in a panel, a roundtable discussion with other entrepreneurs a few weeks ago. It was sponsored by SunTrust in Atlanta, which is where our headquarters is. And there were business leaders, CEOs like myself in small companies from different verticals in the economy. So there were some real estate guys, there were some small business in the food and hospitality business, there were investment businesses, and really a nice cross-section of multiple sectors, completely unstructured, but definitely coverage of many sectors in the economy. And we went through one at a time. Everybody talked about their business. How are sales? How are we doing? Are you getting a good? How's your pipeline and the likes? And as I was listening to people talking around the table, I found that to be very informative. That very small, sampling of the information, I could tell, for example, that real estate has been really, really struggling. People are not able to sell houses. There's no inventory, and people are talking about it, around the table. And I think getting that kind of data in a structured way from the crowd is extremely powerful. And that's what I think is what's going to be more informative, because it comes straight from the heart. And if you have the ability to aggregate that kind of data in an effective way, you can really find some benefits.
Use cases that worth mentioning really depends on where you mention it. I find that when I speak at conferences and events, people really appreciate when I talk about really like fundamental, traditional hedge fund kind of use cases, because quant use cases, they just look boring, like multi-factor models. They just not very interesting. some interesting use cases like satellites counting windows with lights in them to measure vacancy rate at hotels, or corporate jets and measuring how many different companies fly to the same acquisition target to measure their bidding wars, or litigation cases when people are trying to actually determine what kind of circuit of a court this case went to, and based on that they make a conclusion on whether or not it's a big deal. That kind of use cases are interesting. And in terms of what I would like to see, I think there's a big potential in probably less exotic but more powerful data that's, I don't think it's around yet, like financial services companies that are sitting on huge amounts of data that they are afraid of selling because of a personally identifiable information. You can actually reverse engineer and identify their private clients as well as institutional clients. And I think the solution for that is exactly what I mentioned before. If they figure out how to control feature engineering on their side, or hire someone to help them with that, they will still retain a control, and as users we won't be able to reverse engineer it and figure out who their clients are. We don't need that actually, but that would be good to have and make a strong signal.
Great, so we're out of time. Thank you for coming. Please enjoy a cocktail and ask any questions if you have after the panel. Thank you.